This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, picking it up from where we left off last time, we can see here in example 1 that we've got to compute for our taxpayer Tina her capital gains tax liability for our 2018-19 tax year. We'll talk in this section down here about ensuring that on most especially objective testing questions that you're likely to have to deal with so far as CGT is concerned. Likely that we'll find our questions in Section A and Section B on CGT, to make sure that the very specific and precise requirement is correctly interpreted. Now here, as probably in most, it's about computing a figure of tax, a CGT liability. But it might not be. It might be computing taxable gains rather than working out the CGT liability thereon. So very important to carefully read the question. I know it's a truism. We are always careful to read the question. But often on the objective testing questions, where they seem quite short, often we can overlook very important issues. We make assumptions. We see keywords, but we don't actually put it all together. But we'll talk about that issue down here. But here it is the CGT for 2018-19. Now, to be able to work out the tax liability, there's two things that we need to know. We need to know the level of taxable gains and what gains are constituted within the taxable gains, in order that then, when we move on to tax those taxable gains, we know which particular CGT rates are going to be relevant, whether we're talking about the 10% and 20% normal rates for CGT, or whether we're talking the 18% and 28% rates that exist in terms of residential property there. What we also have, as mentioned in our first session, there may be business assets, qualifying business assets that rank for a very special CGT rate, a 10% rate, not just on a very small amount of taxable gains falling within the basic rate band limit, but on gains of, in fact, up to £10 million, those gains that qualify for entrepreneurs' relief. That particular relief is, again, a very special type of relief. It's a tax rate. It's a lower tax rate there. Most reliefs are deductions in something, either what is chargeable to tax or maybe in the tax itself. Here, entrepreneurs' relief, well, that's a reduction in the tax rate, and therefore a 10% rate would apply. We'll see that, however, in Chapter 14 when dealing with the various CGT reliefs. For us, though, what have we got? Sold a painting. Very clearly not a residential property, so it'll be normal rates. But we've got to compute the gain, and very easy it is too. £500,000 of proceeds, £350,000 worth of cost. Well, that equals £150,000 worth of gain. Next one, a property. But look, it's a commercial investment property. Commercial, not residential. That therefore means that the taxable gain on this will be treated like the taxable gain on any other investment asset that we might have, and therefore the 10% or 20% rates will apply. What have we got? Well, we've sold it for £310,000 on the 1st of December 18 and incurred agency fees of £15,000. So what you should have done, of course, in your workings was to get your proceeds of £310,000 less your selling expenses of £15,000, and that would bring you down to net proceeds of £295,000, away from which we deduct our allowable cost. Well, you'd purchase the property for £200,000 there, take your £200,000 away from your net proceeds of £295,000, and that will be another £95,000 worth of gain. One further transaction, not so much involved, but this time it's an antique vase, so again a normal investment asset, not a residential property. So all of these gains will be treated the same. So we'll be doing one CGT calculation on the overall net taxable gains of the tax year. But what is different about this one, sold it for £10,000, cost £15,000. So this time we are looking at a loss of £5,000. So we will put those figures together to work out the net gains of the year. Well, that's fairly obvious. 150 plus 95 would be 245, less 5 is 240. But then we take away the capital losses brought forward from previous tax years of 12,000. That will still leave us with a huge, of course, amount of gain that remains chargeable. It's not, however, yet the taxable gain, because to do that we must we must deduct there the available AEA, which for our tax year will be £11,700. That will give us the taxable gains. But having got those taxable gains, we've then got to compute the CGT. And for that we need to know from our income tax computation what was our figure of taxable income, to know whether or not there was still any remaining basic rate band available to us. If there were some available basic rate band, then given the assets that we're talking in terms of having been disposed of by Tina in this example, then any of those taxable gains falling into the basic rate band would be taxed at 10%. But above that would be 20%. Well, we can see here that Tina's taxable income, note there, not income, but taxable income, i.e. we've already deducted the personal allowance to derive the taxable income for our tax year 18-19 is £50,000. So with taxable income of 50,000, she's clearly a higher rate taxpayer. Therefore, the tax rate based on that level of income is going to be 20%. All we've got to do now, therefore, is put it together. Now, hopefully you've already done that, but let's just look at our figures. Our painting disposal, £150,000 gain. The investment property, remember that was a commercial property, not residential. And that gain, 95,000. The loss on the antique vase 5, there are the net gains of the year, 240,000. Take out your capital loss brought forward, then the net gains remaining, subject to the deduction of the AEA, 228. Take away your AEA for the year, and that brings us down to, this is the figure we need to be able to calculate the CGT liability, it's the taxable gains. In total, 216,300. Remember, we could put all of these assets together in terms of net gains in one calculation because only one set of tax rates were to apply, 10% and 20%, though here the 10% band is irrelevant, of course, because as we've already said, Tina's taxable income of 50,000 exceeds our basic rate band limit of 34,500. And none of the assets sold are residential property, as we've just stated, nor assets eligible for ER. They would be qualifying business assets, as we'll see in Chapter 14. So all of the taxable gain is taxed at 20%. 20% on 216,300 is hopefully, therefore, our 43,260. Now, this question didn't ask you to state what the due date was, but we've dropped it in just to remind you that for any tax year, this is the 18-19 tax year, we pay our CGT, then the following 31st of January. The following 31st of January, of course, here would be the 31st of January 2020. Only relevant, of course, if they ask for it in the question. This one didn't. Okay, having a review through there, hopefully that you are perfectly okay with that one. No problem. And then we'll move on to, best look at the question rather than the answer, there, example 2 in a moment's time. But once we've just explained about interpreting the requirements of these objective testing questions very, very carefully. Right, now as we know, Section A and Section B questions are objective testing. That means you get it right or you get it wrong. You get 2 marks, you get no marks. You don't get anything for getting it part right, mostly right. If it isn't 100% right, it's wrong and you get nothing. On that sort of reward basis, you've got to make absolutely certain that you've read and interpreted the question's requirements carefully and not made an incorrect assumption by rushing it, by reading what you thought was required rather than was actually required. So, CGT is likely to be in some of the questions in section A and one of the 10-mark questions in terms of section B. Very important, as we've said, to ensure that you properly read and understand the information provided in the question and, of course, its requirement. So, for example, does the question give you the figure of taxable gains? Now, the question we've just done, I got you to work out the individual gains, and you might have to do that in an exam question. But does the question give you the figure already of taxable gains? Now, what's that? It is the net gains of the year, less any capital losses brought forward, and also less AEA. So taxable gain is after deducting all those losses and the AEA, the point we make here. That is after deducting any capital allowances and any capital losses there, and the AEA. Or, rather than giving you the figure of taxable gains, does it simply tell you the chargeable gains? Then you would have to compute the taxable gains there and possibly go on then to compute the Cgt liability. Well, if they gave you the taxable gains, you would have to go on and compute the liability there. If they've given you chargeable gains, then you'd have to take away your AEA to bring it down to taxable gain. If they give you taxable gain, we've already deducted the AEA. Don't do it again. And then, of course, for your Cgt liability, the tax rate for Cgt that needs to be applied. You need to know whether you're using the lower rates or the higher rates. Does your taxable income from your income tax computation still leave you within the basic rate band? Therefore, some of that basic rate band is available to you. Or, as in the previous example, there, example 1, is our taxable income such that we've already gone into higher rate, therefore only the higher rates then will be applicable in relation to those gains. You'd need, of course, then to also know about those gains. Do we have any residential property in amongst the various disposals made? Because that, of course, that gain, that taxable gain, that's going to have a higher figure of tax rate to apply to it, the 18 and 28% rates rather than the 10 and 20% rates, of course. So, does the question give you the taxable income of the taxpayer, or does it provide you with the income figures that require you then to deduct the personal allowance? So do they give you the total or the net income figure, or the net figures of income themselves that allow you to firstly get that total and net income, but away from which you must deduct the personal allowance to come up with the figure of taxable income? So they could give you the gains, they could give you the taxable gains, they could give you the income, they could give you the taxable income. You need to know which it is. And of course, as we've said, read carefully the requirement of the question to make sure that you're doing what they're asking you to do and not what you think you should be doing. Does the requirement actually ask you to calculate the Cgt liability of the taxpayer, or simply to compute the taxable gains of the taxpayer? Do we want the tax? Do we want the gains upon which you would base that tax calculation? Does the requirement ask you to compute the taxable gains after AEA, or simply the net chargeable gains, which would be before AEA? So don't rush into those calculations. Make sure you properly interpreted and understood what the question wants you to do. Now, in the following examples, we're going to see some repetitious exercises where it's computing the capital gains tax, the capital gains tax liability. They all mean the same thing there in a few different circumstances, where again we must look at the information provided and interpret what that means in terms of the requirement. So let's try that now with example 2. Calculate Matthew's capital gains tax for 1819. So it tells us to begin with about their income. Trading profit £20,000 assessed in 1819, and no other figure of income provided, because the only other thing we did was to sell an antique vase, giving rise to a capital gain of £18,000. Now again there, antique vase, very obviously, of course, that is not residential property, So it's the lower CGT rates, the 10 and 20 if necessary, 10 and 20%, 20% if necessary, that will be applied rather than the 18 and 28% applicable to, of course, residential property. So the first thing we can do is to work out our taxable gains. Now they've given us the capital gain on the asset. There aren't any losses either of the year or brought forward, so away from that gain of the year, we'll need to deduct our AEA of £11,700. That, of course, will then bring you down to what will be a taxable gain of just £6,300. But then we need to work out the tax on that £6,300. And for that, we need to know about the level of income. So there's the trading profit, £20,000, away from which we will deduct the personal allowance. So 20,000 minus your personal allowance of 11,850. That therefore would give you taxable income on your income tax computation of what that be about £8,150. Well, comparing 8,150 with the basic rate band limit of £34,500, I think it's fairly obvious that when we add 6,300 to effectively 8,150, all of those taxable gains fall within the basic rate band. Therefore, all of those taxable gains are taxed at the lower rate. Which lower rate? It's not residential property, so this 6,300 will all be taxed at your 10% rate. So there, 10% on your 6,300 will of course be £630, and had it been required, you could have said again, well, that will be due the 31st of January 2020. Again, if there's any doubts, have a little read through. I'd like you to have a little read through anyway, the answer to this example, because what we also do is to just, again, make the point that if our level of taxable income had been higher, then of course we may have seen the situation where the figure of taxable gains moved you out of the basic rate band and therefore the 10% rate and up above and into the higher rate band where the tax rate for CGT would be 20%. So have a little review of example 2 before again coming back and joining us, and we'll have then a go at example 3. But check out and fully understand what example 2's answer is telling you there. Well, hopefully you've reviewed through and obviously seen the answer to our particular question, but what this also did was to take it further and say, if that taxable income of the taxpayer had been, say, £29,500, then with the basic rate band limit, of course, of £34,500, then only 5,000 of the basic rate band would remain. Now, as we've got taxable gains here of £6,300, that would push 1,300 of those taxable gains up into the higher rate band, and that would be at 20%. So then your CGT liability would have read 5,000 at 10%, and the remaining 1,300 would be at 20% to compute that CGT liability. Okay, with that in mind, therefore, now, and hopefully understood, let's go back and have a little look at example 3. Again, as we said with all of these, it's about computing the CGT liability, again for our own tax year 18-19. So what have we got? Katie this time, trading profit of 41,000. So again, giving us a figure of income rather than a figure of taxable income. So that £41,000 will have to have the personal allowance of 11,850 deducted from it to bring us to our taxable gains. In addition, she sold a commercial investment property, giving rise to a gain of £30,000. So what have they done? They've given us the income figure from which we compute the taxable income needed to be able to determine the relevant CGT rate to apply to our taxable gains. We know what the rates will be, as it's a commercial property, not a residential property. That means that the lower rates will be applicable, the 10% and 20% rates as appropriate. We've then got, given the figure of gain, we need to work out the taxable gain. So from that capital gain, here 30,000, we deduct our available AEA of 11,700, and that's going to leave us with, what, £18,300 as our taxable gain. We then need to proceed to tax those taxable gains of 18,300 with using as a threshold for that our figure of taxable income off the income tax computation. Now we know that that would have been total, there's only one source of income, trading profit, total stroke net income of 41, less a personal allowance of 11,850, so take one away from the other, and that would leave us with taxable income of 29,150. Well, if you've got 29,150 and you've got a basic rate band limit, okay, they should be the other way around here in terms of what you deduct from the other, but the basic rate band limit 34,500, take away from it 29,150, and we're looking at £5,350, I think there, of remaining basic rate band. We have taxable gains of 18,300, so time now to tax those taxable gains, starting with, as we've already said, 5,350. That falls within the basic rate band still available to us, so it's at 10%. We've got in total £18,300 worth of taxable gains. Take away the 5,350. What is left over still to tax? Well, I think that is 12,950. Just check that. 1780. Yeah, 12,950. That, of course, is now in the higher rate band. We've used up the remaining basic rate band limit available to us, and that, therefore, will be taxed at 20%. Work those figures out, and you've got yourself your CGT liability for the tax year all sorted. Again, obviously, you're getting used to it now. If they had wanted also the due date, that's for 1819, the 31st of January 2020 there. On to example 4. Very similar, in as much as, again, we have a trading profit, not much higher, £45,000. Of course, as we know, this time for Elliot here, it's again the CGT for 1819. So we've got £45,000 in terms of the trading profit. Sold a painting, well, that of course again is not residential property. So we know what CGT rates will be applicable. And we've got a capital gain on that of £26,000. So as ever, first thing we do is to compute our figure of taxable gain before then establishing what CGT rates will be applicable to those taxable gains. Here, as the gain is from one particular asset, that is a painting, it's not a residential property, then it will be the lower rates of 10 and 20% that will be appropriate to the taxable gain. We won't be looking at the 18 or 28% rates. But then they tell us something else, and that is that we made a gift aid payment of £2,400 in 1819. Now, that's not going to impact on us computing the taxable gain. What it will impact on, as I hope you'll recall from our first lecture here in Chapter 12, is the basic rate band limit to use in terms of working out how much, if any, 10% rate band still applies. But let's do what we've always done. That is to calculate our taxable gain. They've given us the individual gain. We take away our, of course, AEA of £11,700, and that therefore will bring us down to a taxable gain of, I think, £14,300 worth of taxable gain. That's the figure to be taxed. Now, what we normally do, of course, then, is from our income tax computation, and then we'll do the same here, we calculate what is our taxable income. There's your £45,000 minus your personal allowance of 11,850. Take it away to get your taxable income. That this time is 33,150. Now that 33,150 I should say, is just below the basic rate band limit of 34,500. But will 34,500 be our basic rate band limit? That, of course, is where this comes in, the gift aid payment of 2,400. Now remember, gift aid payments, personal pension contributions, the gross amount of those amounts paid, what do? They extend the basic rate band limit. If necessary, it isn't here in CGT, but they'd also extend the higher rate band limit as well. But here, it's the extension of the basic rate band limit that is critical. It's applicable in computing your income tax. It's equally applicable now in computing your CGT. So let's see what we have got therefore. We had a basic rate band limit for our year of £34,500. But that now needs to be extended by the gross amount of your personal pension contribution. Now again, it was important there, personal pension here, gift aid payment. Important, of course, if it were a pension contribution, to know whether it was personal or whether it was occupational. The tax treatment that you're seeing here of what is indeed a gift aid payment would only be applicable to pension contributions if they were personal pension contributions, not occupational pension scheme contributions. So this therefore a gift aid payment of 2,400, but that is the amount paid. It is said to be paid, remember, net of basic rate tax relief given at source. So to get the gross, times 100 over 80. Work that through, 24 times 100 over 80, that comes to a nice round £3,000. Add it to 34.5. So we're now looking at a revised basic rate band limit of £37,500. It is that figure that we now compare with our figure of taxable income off the income tax computation to determine, therefore, how much basic rate band remains. So 37,500 minus 33,150. Get your calculators out, guys, and work that figure. Well, I got that to be £4,350. 4,350. How much taxable gain are we taxing? 14,300. Well, that, as we can see here, is bigger than the 4,350 remaining basic rate band. So what does that mean? Your 4,350, that will be at 10%, and the remainder of your taxable gains of 14,300, so just a fraction under 10,000, but the remainder of the taxable gains will then be taxed at 20%. And you work those figures. Now, I'd like you to do that for me, please, and then, of course, once you've got those numbers, check it out with the answer in the back. Make sure you're happy with how we have computed that CGT liability. And what was different about this one is not just that our taxable gains are partly within and partly outside of the basic rate band, but the basic rate band limit itself needed to be increased by the gross amount of the gift aid payment. That would be equally true, we said, if you had a personal pension contribution where the gross amount of that would also have extended that basic rate band. So check that out with the answer, please, and then come back and we'll do one more example to take us through to the end of this particular session. Okay, well, let's have a look through this answer and again understand the process that you pursue. Again, we had to interpret the information in the question as well as the question's requirement. It was, as all of these questions have been so far, to compute the CGT liability. To be able to compute the CGT liability, what information were we working with? We were told about a figure of gain and a figure of income to feed into both the CGT computation and respectively an income tax computation, though we weren't concerned about the amount of income tax liability, simply the level of taxable income from that income tax computation. So job 1, compute the taxable gain. You knew the gain, we took out the AEA. Had there been losses, we would deduct those losses to bring us down, of course, to, after then deduction of AEA, again to our taxable gain figure. We then needed to know, if we have the taxable gain, what tax rates will apply. To do that, we needed our income tax computation, one figure therefrom, our taxable income. We would ordinarily compare that taxable income with the routine basic rate band of £34,500. But as we've seen, this basic rate band had to be extended by the gross amount of the gift aid payment. That again we saw. Be careful with exam questions. Again, they may tell you the gross figure. If they do tell you the gross figure, they will have that in brackets next to the amount. It would have been paid £3,000 in brackets gross gift aid payment. You therefore would already have the gross figure. Here though, we had to work it out. Well, 3,000 plus 34,500, there was the 37,500. Work out the basic rate band remaining by taking 33,150 now from 37,500. That's what gave us our 4,350. Now you can do your tax calculation. 4,350 of the £14,300 worth of taxable gains at 10%. Take your 4,350 away from 14,300, leaving you with a balance of 9,950, and that's now into the 20% band. Calculate that figure, add it together, and there, I hope, computation permitting, there is your CGT liability. Again, you know when the due date would be, when that due date would be, only relevant, of course, if they ask for it. So we've got 2,425 in relation to the CGT liability. Okay, one more exercise then to deal with. What new thing can they possibly bring in here? Well, let's see what we've got. Again, of course, this time for our heroine Gaynor. Gaynor here, she had a trading profit assessment of 21,500 in 1819. So again, an income figure, no other taxable income. So she's only got the £21,500, away from which, of course, we will deduct our personal allowance to give us what would then be the taxable income figure. Well, more of that in a moment's time. She sold this time 2 assets during our tax year. A residential investment property. They've given us the gain, we don't have to work it out, 30,000, and separately a diamond ring, which yielded a gain of £8,000. So we've got this time 2 disposals, both giving rise to gains, but this time we cannot put these gains into a pool and into one CGT calculation. The reason being that the gain on the residential investment property, that is going to suffer the higher rates. Anything, as we know, falling into the basic rate band, that would be at 18% rather than 10%. Any of it falling into the higher rate band, well, that would be at 28% instead of 20%. It also leaves you with a further problem. In terms of computing taxable gains, the first exercise, because now we've got to divide it into 2, the gains eligible for the 10% and 20% rate compared to residential property where it's 18 and 28, we need to be able to deduct any deductions, i.e. any losses. There are no losses here, but then any AEA from one or other of those gains. So which do you think would be the gain to deduct the AEA from? Which gain do you want to reduce down? Which taxable gain do you want to be lower? Now, that should be an easy question to answer, because we know that the investment residential property is going to be 18% or 28% and or 28%, whereas the gain on the diamond ring is 10% or 20%. That tells you, therefore, that you deduct the AEA from the property gain. So this time you would set up, well, again, it's only a working here. You'd only write this out properly if you were doing it in a Section C question, which is probably not that likely. But you got your property, you got your ring, you've got your gains, 30,000, 8,000. We have one AEA. Where do we put it? Most definitely against the property gain. 11,700 against that. Nothing against the ring. To bring you to your taxable gains. And that therefore will be, well, the ring hasn't changed. That's £8,000. The property, of course, is the gain to be reduced, and that will come down to 18,300. So we've got there our two figures of taxable gain. We then need to know what CGT rates will be applicable. So for that, it's back to your income tax computation. What is her taxable income? Well, her income, 21,500, minus the personal allowance, 11,850. Put that through your calculator, and that therefore should leave us with taxable income equal to £9,650. Compare 9,650 with your basic rate band limit of 34,500. Again, it will be the standard 34,500 here. Reason being, there is no reference to any payments being made either as gift aid payments or personal pension contributions. So the basic rate band limit is the standard £34,500 figure. So you get your 34,500 minus the 9,650, see what is available. Then you have the basis for taxing those taxable gains. Now, not that it will matter, and we'll explain that in the answer in a moment's time, but I'd suggest here that what you would do is to firstly tax the taxable gain on the property before then moving on to tax the gain on the ring. What we can see is, with a combined amount of 18,300 plus 8,000, 26,300. 26,300. When we add that 26,300 to our figure of taxable income of 9,650, that is going to take us not much, but just over the basic rate band limit of 34,500, and therefore one part of one of these gains is going to go into the higher rate bracket and either be taxed at 28 instead of 18 or 20 instead of 10. So not as I say that it will matter which issue I'll explain in the answer, but I would ask you now to tax these gains, and I would deal firstly with the property and then secondly with the ring. But as we'll see, it actually won't make any difference anyway. But work that out for me, compute the CGT liability, please, and then we'll have a look through the answer together and bring this particular session to an end. Okay, so here we've got our answer, therefore, the figures that we already know. We had, of course, as we always do here, firstly computed our taxable gains, but this time split between the property, where the higher CGT rates would be applicable, as compared to, well, basically any other type of asset there other than residential property, where the lower rates would apply. To be able to know what amounts would be applicable within which rate band, we needed, of course, to be able to determine the level of taxable income of the income tax computation and the remaining basic rate band limit. The only other point, of course, in here, as we explained, is that the AEA was deducted from the residential property gain, because that's the one that's otherwise taxable at the higher CGT rate. Now, I then said for you to compute the tax, taxing firstly the gain on the property, and then moving through to deal with the gain on the ring. So, we needed to know out of our remaining basic rate band limit, what was left, therefore, to use up at the lower 18% rate. So what have we got? Taxable income of gainer, we'd already done this, 9,650, and that leaves an unused basic rate band, 34,500 minus 9,650 of 24,850. Well, as the gain, taxable gain on the property is only 18,300, all of that 18,300 falls within the basic rate band limit, so therefore we get the benefit of the 18% rather than the 28% rate. And that figure, hopefully, 3,294. We now move on to our remaining taxable gain of 8,000. We'll work out how much of the basic rate band limit still remains. We had 24,850. We've just used 18,300 here on the residential property. So that leaves us 6,550, and that will go against the gain on the diamond ring. So 6,550 at 10%, 655. How much of the gain has that covered? 6,550 out of 8,000, it leaves 1,450. That's now up in the higher rate. That's 20%, and that's 290. Add it down, cross-cast, we get £4,239 as the CGT liability. Now then, I would routinely do it that way, calculating the CGT firstly on the residential property before then moving to the CGT on any other net gains that you have. But actually it wouldn't matter. What did matter was the fact that that AEA was deducted, as would any losses available be deducted, from the gain that would suffer tax at the highest CGT rate, i.e. the residential property. That had to be done. But then, whether you taxed as we did here, the taxable gain on the property first, or the taxable gain on the ring first, as we'll prove in a moment, it won't affect the CGT liability, because the 1,450 is the extra gain that we're talking in terms of the outside of the basic rate band. And all that's going to happen on the 1,450 is that it is going to be taxed at, well, the extra 10%. It's either going to be 20 instead of 10 or 28 instead of 18. So the extra tax is exactly the same. Now, again, if we don't believe me, just look at the calculations. If we do our calculation of the tax firstly on the ring, all 8,000 is at 10%, £800. That therefore leaves us with 16,850 of the basic rate band remaining to us. Again, you can prove that figure going back to the 24,850 remaining basic rate band that existed from your income tax computation. 16,850 would be at 18%, and that would leave the self-same 1,450 pushed out of the basic rate band and up into the higher rate band. What does that therefore mean? It means that that will be at 28 instead of 18. So on that, it's an extra 10% over and above what we'd already have paid. Work out your figures of tax, and oh, what a surprise, we get 4,239. Now all that shows is it doesn't matter which way round you tax your taxable gains. But don't even worry about it. Simply do as we did in this first calculation and tax the taxable gain on the residential property first of all, using up any remaining part of your basic rate band before, if necessary, then moving into higher rate. Then bring in the taxability of any other assets at their respective rates. Here on the diamond ring, the 1,450 at 20%. But literally, it will not matter which way round you do it. Okay, so what that should now mean is that whatever the requirement, whether it asks us to compute as these have done, CGT liability, or whether it asks for taxable gains. We can initially, if necessary, compute individual gains and losses, get our net gains of the year, take out if there are any capital losses brought forward. Once we've got then the net over all chargeable gains of this year to be charged to tax, we take out the AEA, and that gives us the taxable gain. Once you've got the taxable gain, split if necessary, as in this question, between residential property and any other gains, we can then proceed to tax, but only once we know, is there any basic rate band remaining? Remember that the basic rate band, instead of being 34.5, may have to be increased, will have to be increased, if you've made any personal pension contributions, or as in one of these questions we've done, any gift aid payments during the tax year. Get the gross figure and add it to 34.5, get the extended basic rate band limit. See how much of that basic rate band still remains, and that then will be enjoyed by your taxable gains. It won't matter whether you've got residential property and other gains. It doesn't matter which one you tax first, but routinely just go with the residential property would be my advice. And tax at 18% for any remaining basic rate band available, and then up if necessary to 28. Then deal with the other gains if there's no basic rate band still remaining at 20%. If there is still some basic rate band remaining, it at 10, and any excess above that then at 20%. And get your CGT liabilities. Check out though, do they want you to calculate the CGT liability or just taxable gains? And in the question, do they simplify it by actually telling you a figure of taxable income instead of income, so you don't have to deduct the personal allowance, it is already done? Or do they give you a figure of taxable gains, which of course means we have already deducted the AEA, you don't go and do it again. So check out the numbers, look at the requirement, work your figure. But again, spend a moment before rushing in to any such question to make sure you've interpreted both the requirement and the information correctly. Okay, that brings this session to an end, and still a couple of sessions to go in terms of this, again, substantive chapter on our introduction to CGT, but we'll pursue this chapter as far as we can in our next lecture together.